Today, we highlight the top global stories impacting our world, from Bitcoin's struggles to the implications of the Clarity Act. We'll also explore the shifting landscape of cryptocurrency regulations and institutional influences. Here are today's top 10 stories you need to know. Ethereum and Solana have emerged as the primary battlegrounds in the cryptocurrency space. Both platforms are vying for dominance as they each offer unique advantages in smart contracts and transaction efficiency. Ethereum remains the anchor asset for smart contracts, while Solana is known for its speed and user experience. Recent predictions suggest that if the Clarity Act passes, both Ethereum and Solana could reach new all-time highs. This is significant because regulatory clarity could unlock new investment avenues, making them more appealing to institutional investors. Market analysts believe that Ethereum typically leads market movements when sentiment shifts towards altcoins, while Solana often outperforms in speculative environments. Investors are cautiously optimistic, yet remain vigilant as they track any developments in regulations that could impact these assets significantly. As the crypto landscape continues to evolve, the competition between Ethereum and Solana is likely to intensify, with both aiming to capture a larger share of the market. The flow of funds into exchange-traded funds, or ETFs, has become a crucial indicator of demand for cryptocurrencies like Bitcoin, Ethereum, and Solana. Recent analyses suggest that ETFs may purchase more than 100% of the new supply of these assets. This phenomenon is vital because it creates a scarcity effect that can help stabilize and potentially increase the asset's prices. If ETFs continue to absorb all new supply, it could lead to a sustained bid under the market, especially for Bitcoin. Institutional interest is a game changer, as it provides a more traditional approach to portfolio construction that could attract further capital into the cryptocurrency market. As traders closely monitor daily flow data, the sentiment surrounding ETFs remains bullish, indicating that the long-term outlook for these cryptocurrencies could be very positive if institutional demand persists. The implications of this trend are significant, as the dynamics of cryptocurrency investing continue to shift. Despite recent market pullbacks, institutional demand for cryptocurrencies remains a central theme in 2026. Institutional investors continue to participate actively, demonstrating that the market is no longer solely driven by retail speculation. This is critical because it means that large institutional flows can cushion market downturns, preventing sharper declines. However, if these investors begin to withdraw, it could lead to increased volatility and accelerated downside movements due to thinner liquidity. The market is currently assessing whether recent dips will result in ETF inflows or redemptions. If institutional demand stays robust, it could support a quicker recovery for the market. This ongoing interest from institutions is reshaping the landscape, making it essential for traders to monitor the movements of these larger players closely. As we look ahead, the role of institutional investors will likely become even more significant in determining the future trajectory of cryptocurrency prices. A forward-looking narrative emerging in the cryptocurrency sphere suggests that Bitcoin's volatility may be decreasing, potentially making it less volatile than tech stocks like Nvidia. This is a remarkable shift, as Bitcoin has historically been seen as a highly volatile asset. If Bitcoin's volatility continues to compress, it could change how institutions allocate it within their portfolios. Lower volatility may attract more conservative capital, allowing Bitcoin to be viewed more as a macro asset rather than a speculative one. However, while this could stabilize Bitcoin's price movements, it may also lead to slower price rallies, which could disappoint some traders who thrive on high volatility. The evolving nature of Bitcoin's market dynamics is indicative of its maturation as an asset class, and investors will be keenly observing how this trend develops. This potential shift in volatility could have far-reaching implications for how Bitcoin is perceived and traded in the coming years. The Clarity Act is emerging as a potentially market-moving piece of legislation in the United States. This act seeks to establish a clear definition of digital assets, specifically determining which of them qualify as securities. This classification is crucial for the cryptocurrency market's future, as regulatory ambiguity has hindered growth and innovation. Should the Clarity Act pass, it could reshape the landscape of cryptocurrency regulation, offering much-needed clarity for investors, institutions, and developers alike. A transparent regulatory framework would not only enhance investor confidence, but could also attract significant institutional participation, which has been largely hesitant due to regulatory uncertainties. Furthermore, a clear definition could stimulate innovation within the blockchain space, encouraging new projects to emerge. As stakeholders closely monitor the legislative process, sentiment remains mixed, with many hoping for a favorable outcome. The trajectory of the cryptocurrency market may hinge on the passage of the Clarity Act, and its potential approval could lead to a more robust and responsible digital asset ecosystem in the near future. Bitcoin is currently facing significant pressure as a risk-off sentiment permeates global markets. Recently, the cryptocurrency slipped below the crucial $81,000 mark, a psychological threshold that traders closely monitor. This downturn is largely attributable to escalating geopolitical tensions, particularly following the rejection of a peace proposal concerning Iran, which has rattled investor confidence. Such macroeconomic risks often compel investors to de-risk across various asset classes, including the notoriously volatile cryptocurrency sector. Bitcoin's recent price action indicates it remains a high beta asset, highly sensitive to shifts in broader market conditions. The ripple effects of this volatility are evident, dragging down other major cryptocurrencies like Ethereum and Solana. Analysts are now closely observing whether institutional investors will seize the opportunity to buy the dip, or if the prevailing selling pressure will continue to dominate the market. As the situation develops, the resilience of the cryptocurrency market will be tested, with many anticipating that Bitcoin's ability to recover may hinge on the resolution of these geopolitical tensions. The cryptocurrency market is currently experiencing a profound transformation, primarily driven by increased institutional participation. This shift marks a departure from the previous dominance of retail investors, who largely fueled speculative trading. Institutional investors, including hedge funds and asset managers, bring not only substantial capital, but also a level of sophistication that enhances market maturity and credibility. Their entry into the space has been spurred by growing acceptance of digital assets and the pursuit of diversification in investment portfolios. As these institutions continue to buy into cryptocurrencies, we may witness a decline in price volatility, fostering a more stable investment environment for all players. Conversely, should there be a sudden withdrawal of institutional capital, the market could face dramatic fluctuations, reminiscent of earlier volatility. Analysts and traders are closely monitoring these developments, recognizing that the ongoing evolution of institutional involvement will significantly shape market dynamics. Looking ahead, the interplay between retail and institutional investors will be crucial in determining the trajectory of cryptocurrency valuations and overall market health. Regulatory clarity remains a significant concern for the cryptocurrency market as it grapples with evolving legislative landscapes. Recently, the introduction of the Clarity Act has sparked discussions about the future classification of digital assets. This proposed legislation aims to provide a clear framework that could define cryptocurrencies and stablecoins, which is critical for both existing investors and potential entrants into the market. The outcome of such regulations could either bolster confidence in the market or lead to increased caution among investors. Positive regulatory developments could significantly spur institutional interest, attracting more capital inflows from traditional finance. Conversely, negative outcomes might trigger panic selling, resulting in sharp market declines. Currently, market sentiment is cautiously optimistic, with many stakeholders believing that regulatory frameworks will evolve to foster innovation while ensuring adequate investor protection. As the cryptocurrency landscape continues to shift, the potential for new investment opportunities and growth remains high. Stakeholders should remain vigilant regarding regulatory updates, as these changes could dramatically reshape the investment landscape. In the coming months, clarity on regulations will likely dictate market dynamics and investor strategies. Bitcoin is currently facing significant price fluctuations, having recently slipped under the critical $81,000 mark. This downturn is largely attributed to broader market dynamics and ongoing geopolitical tensions that are dampening investor sentiment. The recent volatility is particularly concerning for traders who believe that a stable price is crucial for attracting new investments to the cryptocurrency market. Analysts note that Bitcoin's price movements are intertwined with macroeconomic factors, including inflation rates and interest rate changes, as well as global liquidity conditions. This complex interplay has led many investors to adopt a cautious to bearish outlook in the short term, even as some remain optimistic about a potential recovery in the long run. The immediate market reaction hinges on whether institutional buyers will step in to support Bitcoin's price, or if further selling pressure will exacerbate the decline. The current situation highlights the critical need for investors to monitor Bitcoin's price action closely, as it has broader implications for the entire cryptocurrency ecosystem. As Bitcoin navigates this turbulent landscape, the market anticipates that upcoming regulatory developments and economic indicators will play a pivotal role in shaping future price trajectories. Investors are particularly keen on how these factors will influence Bitcoin's resilience moving forward. Bitcoin is under significant pressure, having recently fallen below the critical $81,000 threshold. This decline reflects a broader risk-off sentiment driven by escalating geopolitical tensions, particularly following the rejection of a peace proposal concerning Iran. Such developments have intensified fears of instability in an already volatile region, prompting investors to reassess their risk exposure. The cryptocurrency market has become increasingly correlated with global financial markets, leading to heightened sensitivity to macroeconomic factors. As energy prices rise and concerns mount over international conflicts, traders are pulling back from speculative assets, including Bitcoin. This reaction underscores Bitcoin's status as a high beta asset, which tends to respond dramatically to shifts in market sentiment. Such volatility can have cascading effects, dragging down other major cryptocurrencies like Ethereum and Solana. Investors are closely monitoring whether institutional players will seize the opportunity to buy the dip, or if prevailing fear will lead to further selling pressure. The outcome of this situation could significantly impact market dynamics, setting the tone for the cryptocurrency landscape in the coming weeks. Analysts suggest that if Bitcoin can stabilize above the $80,000 mark, it may attract renewed interest from both retail and institutional investors, potentially leading to a recovery in the broader market. Thank you for joining us today. Which story shocked you the most? Don't forget to like and subscribe for more updates.